Hi there. In our last video, we talked about what is an asset, what is a liability, what is equity, and what is revenue, and what are expenses. And we talked about all the different examples of those. So that's really important information that we're now going to apply here. If you're still not sure, can you please go back to week 1 and week 2 and watch the videos there and do the practice exercises. So in this video, we're going to look at how do you analyze business transactions using the accounting equation, or we can call it transaction analysis. And this is also explained in chapter 3 in your financial accounting textbook. And I've taken this example from chapter 3. So if you want to get a little bit more information, you can also go follow along there. So at the top of this table, I have the accounting equation. So first of all, I have assets here, and examples of assets in this question are going to be cash, accounts receivable, supplies, and equipment. Okay, then I have liabilities over here, and I have 2 liabilities, unearned revenue and notes payable. And then I have equity, and there's 2 equity accounts, contributed capital and retained earnings. And when we do this activity, please notice that the total of all of the assets must be equal to the total for the liabilities and equity. So our accounting equation must always balance. Now, one thing to note with equity, particularly retained earnings. Do you remember the formula for retained earnings? Can you write it down now? Retained earnings is equal to your beginning balance plus your net profit and minus the dividends. So net profit includes revenues and expenses. So in this activity, any revenues, expenses, or dividends, I'm going to include those in the retained earnings just for this activity. Okay, so this is what we would call a business transaction. This is something that the business does in their everyday operations. So in accounting, we want to identify the transaction and then record it into the accounting equation. So we need to read this transaction and then see where would this go in the accounting equation. After registering the business name, so this business is brand new, just starting, Video Memories, the owners deposited $15,000 into the business bank account. So how would this impact the accounting equation? First of all, the owner is depositing cash into the business bank account. So the cash in the business is going to increase. We could put a plus there. And then we have a think about, okay, if the cash has increased, where did this cash come from? It's come from the owners. So this will be part of your owner's equity. And the definition we looked at, contributed capital, is money invested by the owners. So this will also increase the contributed capital in the business. And we just check each time. Does $15,000 equal to $15,000? Yes, it balances. It has to balance. In number 2, Video Memories purchases 2 video cameras for $9,000 and supplies for $1,000, and they paid cash. So look for the keywords. We have equipment. Now, when you purchase equipment, this means you have more equipment in your business. It's an increase. And if you purchase supplies, it means you have more supplies in your business. That is also an increase. Now, when you buy something, normally you will pay cash for that. And so it tells us here that they have paid cash. So in the cash column, I'm going to put how much cash was paid. I'm going to add these up together, and I'm going to make that a minus 10,000. Now this is interesting here. I've got a minus 10,000 plus 10,000. So you see how that cancels out, and that equals to nothing on the other side. So what's happened is I've just taken some cash and used that to buy another asset. One asset went up, one asset went down, and it cancels out. So altogether, there's no change in the total assets. In number 3, Video Memories receives $1,500 immediately after filming a customer's wedding. Okay, receives $1,500 means we are receiving cash from our customer. So I'm going to increase cash 1,500. So again, when you receive cash, you think, where did that cash come from? Why did we receive the cash? Because we've given the service to our customer. And every time you give the service to the customer, this means you have earned revenue. And so we're going to increase the revenue. Where do we put revenue? Remember we said over here that we add net profit to retained earnings, and part of net profit is revenue. And when revenue goes up, net profit goes up, so the retained earnings will go up. So revenue is going to increase retained earnings. I'll put an R there, just so we know that this amount in retained earnings is from revenue. Number 4, Video Memories receives $2,000 to film a customer's wedding anniversary in a few weeks' time. So receives $2,000 again means we're receiving cash. And then we need to think about, why did we receive cash? So this is from the customer. But have we given the service to the customer? It tells us here that we're going to do it in a few weeks' time. So this means we owe the service to the customer. If you owe something, that's what we call a liability. And this particular type of liability is unearned revenue. Now, what is happening to the liability? Do we owe more or less? We owe more because we've received the money. We now owe more services to our customer. So the liability will be an increase. And again, we just check each time, plus 1,500 equals plus 1,500. Plus 2,000 equals plus 2,000. It's got to be equal every time. Number 5, Video Memories paid $250 in cash for Facebook advertising. So first of all, I can see paid cash. So that is now going to be a minus to cash because a paid is a decrease. And we've paid for advertising. Now, advertising is an expense for the business. What happens when we have expenses in the business? This will decrease our profit. Now, because we add profit to retained earnings, we're going to put the expense over here. Now, because profit is going to decrease, we're going to put this as a minus. And you'll notice that that is the opposite to what we did for revenue. The expense is going to decrease retained earnings, and that is equal to the decrease in cash. It does balance. Okay, could you please pause the video now, and could you please complete the rest of those transactions? You can download this document and fill it in yourself. Once you've done that, start the video again. Okay, so how did you go? Let's continue with the rest of it. 6, they film a dance competition. Okay, when you film a dance competition, it means you're doing the job for the customer. So this is going to increase revenue, which increases retained earnings. Then it says leaving an invoice or a bill with the customer asking for payment. So this means we have provided the service to the customer, but we have not yet received any money from the customer. So it's not cash this time. We are going to increase the accounts receivable. In number 7, we purchase another video camera. So we are going to increase the equipment for $9,000. And it says by signing a 9-month note payable. So this means we have bought the camera, but we have not paid for it yet. We owe the money. This is a liability for the business. And we're going to use notes payable because that's what it says here. Notes payable is just a contract that you sign. It gives you the due date and it also requires you to pay some interest as well. They give you details about the interest, but we don't need that at the moment. That's something we'll use later on in next week's lecture. In question 8, we receive cash from the customer. So this will be increasing our cash. Now, what else do we do here? It's from the customer in payment of the invoice from transaction number 6. So let's go back up to number 6 and see what happened. We've earned the revenue, so that's already recorded, but we didn't get the money. So we recorded this as accounts receivable. Now we are receiving the cash from this accounts receivable. So we need to cancel the accounts receivable. So we do the same amount in accounts receivable as a minus, and we increase the cash. One asset goes up, one asset goes down. It's the same number, it will balance. And what is left in accounts receivable? There is nothing left in accounts receivable, which means we've now collected all that money. Number 9, we pay wages. Okay, pay means cash. Pay cash, so that will be minus. Wages means expense. So, as we did before with advertising, when expense increases, this will make your profit lower. Profit is added to retained earnings, so it means you'll have less in retained earnings. And you can always check, minus 2,000 equals minus 2,000. And at the end of the month, Video Memories owners withdraw $1,500 for personal use. This is what we can call a dividend or drawings. Okay, withdrawing $1,500 means taking cash out of the business. Now, this is similar to what we did for expenses. When a dividend increases, it's going to make retained earnings decrease as well. And so it will be a minus in retained earnings because a dividend decreases retained earnings. Once you've completed that, you can do this yourself. You add and minus each column and you get the totals in each column. Then you add up all the balances for assets, and that should be equal to your totals for your liabilities and equity. So you can do the same thing. Add and minus each column and then add up the totals.